Hey everyone, welcome back. We've got a seriously fascinating explainer for you today. If you just casually glanced at the closing ticker for the Indian market on May 19, 2026, you'd probably think, wow, what a sleepy, uneventful day. But as we know, the surface almost never tells the whole story. Today, we're cracking open the data to uncover this massive undercurrent of shifting capital. We're talking heavy-hitting institutional moves, targeted sector rotations, and a deeply bifurcated trading session. So, let's jump right into the charts and see what was actually going on while the headline index barely budged. Just look at this chart. Beneath that seemingly flat close was absolute turbulence. We are definitely not looking at some gentle sideways drift here. The morning session gave us these sharp, jagged peaks pushing high up into the green, and then an aggressive, sustained sell-off that just dragged the index down into the red by the afternoon. What you're tracing right there is a massive 195.1-point intraday swing, literally a roller coaster for day traders, completely contradicting those quiet headline numbers.
But here's the crazy part, the punchline to all that intraday chaos. Despite all of those wild swings, all that climbing and falling on the chart, the Nifty index ultimately closed just slightly in the red, down a mere 0.14%. I mean, that's practically a rounding error. If you only looked at this closing percentage, you'd completely miss the intense battle between buyers and sellers that defined the whole session.
So you might be thinking, was nobody trading? Was it just a lack of participation? Absolutely not. Look at this number. Nearly 39 million trades were executed during the session. That confirms massive market liquidity and incredibly strong investor participation. People were out there buying and selling aggressively. The real mystery we have to solve is, if nearly 39 million trades essentially resulted in a flat market, where exactly did all this money go?
Here's the roadmap for today's explainer. First, the intraday roller coaster, then a tale of two markets, momentum winners and losers, the real estate boom, and finally, macro drivers and tailwinds.
All right, starting with part one, the intraday roller coaster, deconstructing the volatility.
Okay, so over 131,000 crores in total monetary value changed hands, with a traded quantity exceeding 54,000 locks. This level of market depth proves beyond a shadow of a doubt that this wasn't just some low-volume, insignificant day driven by a few erratic trades. No way. This was heavy institutional capital moving in and out of the market in a highly strategic way.
But check this out. This is a crucial piece of the volatility puzzle. Even with that downward pressure at the close, the India VIX, which you probably know is the market's fear gauge, actually dropped to 18.6750. So what does a cooling VIX tell us on a day when the broader index closed in the red? Well, it means the selling wasn't driven by blind panic. Instead, this drop suggests calculated profit-taking and really strategic sector rotation. Investors weren't fleeing the market entirely, they were just moving their money across the hall.
Which leads us perfectly into part two, a tale of two markets, tech versus banking.
This is where the divergence gets really wild. On one side, you have this explosive flight of capital straight into technology, with the Nifty IT sector rocketing up a massive 918.20 points. But on the other side, significant bleeding. The Nifty Bank dropped 127.85 points. This is exactly what that cooling VIX was hinting at. The money didn't evaporate, it rotated. People took their profits out of the heavyweights in the banking sector and aggressively deployed that exact same capital into tech.
And you can clearly see this dynamic building across the broader market if you look at the bars on this chart. Nifty IT is just a towering positive outlier, while some resilience and energy managed a positive close of nearly 50 points. However, look at the traditional cyclical sectors like infrastructure, they're lagging behind, dropping over 30 points. The sentiment here is super selective. Investors are picking very specific growth narratives. They are definitely not betting uniformly on the broader market right now.
Moving into part three, momentum winners and losers. Let's see who actually moved the needle.
Looking at the top gainers list, it completely validates the macro sector view we just talked about. Infosys is up 4.76%, HCL Tech is up 2.86%, Tech Mahindra up 2.59%. These tech giants are absolutely acting as massive magnets for institutional capital. The market is overwhelmingly prioritizing the global digital transformation theme. Investors see these companies as resilient to broader economic slowdowns, and they're just aggressively chasing that superior growth narrative.
On the flip side, look at who's bleeding. Traditional stalwarts are facing really significant targeted selling pressure. Kotak Bank dropped 2.51%, Ultratech Cement dropped 1.67%, and we're seeing losses from Tata Consumer and Titan too. It's a distinct pattern. Highly cyclical, traditional sectors like finance, staples, and manufacturing are battling negative sentiment and profit-taking. Capital is actively being pulled out of these value plays.
And it gets even crazier when we step outside the Nifty 50 and look at the top 25 securities overall. The bifurcation is extreme. Apollo shot up an incredible 9.55%, and Triveni Turbine jumped almost 7%. But then you have Jainrec experiencing a massive crash, dropping 15.68%. This just perfectly showcases a highly momentum-driven market. Investors are chasing momentum and high returns, totally bypassing the whole concept of steady, broad-based market stability.
Let's pivot to part 4, the real estate boom. We need to unpack this CapEx story.
So we're seeing some absolutely massive capital injections right now. Private institutional funding is fueling aggressive domestic expansion. Neolive is investing 500 crore rupees into housing plots and villas. The Karyan Group is pouring 900 crore into luxury housing in Ghaziabad. Omoxy just raised a 75 crore fund. This is not a minor blip. This is an undeniable case that private institutional funding is fueling a rapid expansion in domestic housing. The private residential real estate sector is clearly entering a phase of tremendous confidence.
And importantly, this isn't just people throwing money at speculative ideas. Look at Puravankara. They're reporting really strong financials, driven by continuous project delivery across 9 different cities. This totally validates the thesis. Massive institutional funding is meeting sustained, actual consumer demand. The domestic growth engine is firing on all cylinders in the real estate space.
Finally, part 5, macro drivers and tailwinds. Time to zoom out to the global context.
So a huge global narrative right now is the hope for a US-Iran deal, which has the direct, immediate effect of cooling crude oil prices. Why does that matter so much for the Indian market? Well, lower oil prices significantly reduce input costs for domestic businesses and really improve the national trade balance. That global geopolitical stability directly translates to a much more appealing domestic environment, which is exactly why we're simultaneously seeing Indian bonds gaining strength as inflation fears cool off.
Back to tech for a second. We're getting massive signals of corporate confidence too. Remember that IT rally we looked at on the charts earlier? It's being structurally supported by moves exactly like this. Cognizant is boosting its buyback target to a staggering $2 billion. That sends a huge message to the market. It signals that management believes deeply in their future cash flow strength, encouraging investors to keep pouring capital in, regardless of any broader global economic worries.
So put it all together. Cooling oil, booming domestic real estate, remarkably resilient tech, it leads to incredibly bullish long-term projections like this one from MK Global, forecasting the Nifty to hit 29,000 by 2027. Institutional analysts clearly believe India's structural domestic growth story is powerful enough to override near-term global volatility or temporary sectoral dips.
Okay, let's tie this all together. What we're really looking at today is a textbook case of sectoral divergence. That's when a broad market index remains relatively flat, like we saw today, but the underlying sectors experience extreme opposing movements of capital flow. We saw a flat Nifty 50, sure, but underneath the surface, we witnessed a violent rotation of money out of traditional banking and heavily into technology and real estate.
So what's the takeaway? Here's your actionable wrap-up from today's explainer. 1. Keep a really close eye on the continued capital flow into tech and real estate. That is where the growth narrative lives right now. 2. Monitor the rotation out of banks and cyclicals. Caution is definitely warranted there until a positive catalyst shows up. And 3. With oil cooling and bonds gaining appeal, think about blending your high-growth equities with stable bonds to navigate that intense intraday volatility we charted at the very beginning.
I'm going to leave you with this final thought to chew on. As domestic capital expenditure continues to boom and these tech giants keep flexing their cash reserves, which traditional sector do you think will be the next to face a capital squeeze in this highly selective, momentum-driven market? Ultimately, it's a question of where the money flows next. Thanks for hanging out with us for this explainer. Keep your eyes on the charts, and we'll see you next time.